Welcome back, everybody. It's your favorite investment strategist, Larry, and today we have a lot to cover, over 40 slides that I plan to fully cover in less than 20 minutes. We're going to be talking about how to spot the signs of emerging recessions and how to prepare accordingly with a strong investment strategy. I'll walk everyone through an overview of the nature of recessions. I'll discuss macro and company-specific analysis for recession indicators. We'll talk about how to best prepare for one, and then finally we'll discuss commentary on China's latest internet rebound and what we did inside our inner circle, and objectively speaking, opportunities that we seized and any opportunities that we left on the table. So an example is discussing Alibaba potentially going to 85. That's what we talked about inside Patreon, how it was a high risk but a high reward setup at $100 a share when it was equivalent to approximately 12x PE. And then later I'll show you a clip of how one of our members, Kieran from Singapore, was able to take advantage of our latest market correction with our investment strategy. I want to thank our sponsor, Webull, for sponsoring my videos for the month of March. Get up to 5 free stocks valued between $2,700 and $9,700. The link is in the description below. And with that said, let's get started. I want to walk you through the nature of recessions just so that everybody is on the same page. According to the National Bureau of Economic Research, a recession is a significant decline in activity spread across the economy, lasting more than a few months. It impacts industrial production, employment, real income, and wholesale retail trade. Now, I want to talk about the micro and macroeconomic implications of recessions. On the macro side, we're looking at 2 quarters of negative GDP growth, levels of spending dropping, aggregate prices falling, and unemployment rising, and layoffs dampening consumer confidence. On the micro side, on the company-specific consideration, that's when you see companies start reporting falling margins, negotiations with creditors asking for more favorable terms, the cost of borrowing starting to increase because of those renegotiations, and then reduction in workforce limiting employee advancement. Now, recessions and the likelihood of an upcoming downturn is a timely topic because I follow famous investors like Warren Buffett, like Charlie Munger, and also Carl Icahn. And Carl Icahn recently said that there very well could be a recession or even worse. So let's evaluate the likelihood of a recession using some macro and company-specific research that I want to show you. Now, in previous downturns, like the coronavirus crisis that happened in March 2020, we have a metric called high-yield credit spreads widening significantly during times of turmoil and market stress. We can see that the latest correction that the NASDAQ and the S&P 500 experienced did not cause credit spreads to widen out as significantly during this latest market sell-off. In addition, when we take a look at the yield curve and the inversion between the yield curve, meaning we have the short end part of the yield curve, the 2-year, and then we have the longer part of the yield curve, the 10-year. Yes, their spread is narrowing close to zero, and a lot of economists like to say that when that spread goes negative, that means the yield curve has inverted and therefore a recession is coming. What is also important to note is that usually a recession can come after the yield curve has inverted 12 to 18 months later. So while that means that the yield curve is very close to inverting, it doesn't mean that a recession is going to happen this quarter or next. It could happen sometime in the next 12 months. So you do have time to prepare. It is not too late to prepare for a recession market. Now, another metric that I like to look at is the difference between the 3-month T-bill and the 10-year yield. We can see that the gap between the shortest maturities out there in the bond market and the 10-year continues to be a respectable gap in spread. So I don't think that a recession is in the cards for the next quarter or even 2 quarters from now, but 12 months from now, that's when we start to be a little bit more cautious. Taking a look at the 10-year yield, this is a proxy for economic growth. And even though the yield curve has flattened, the fact that the 10-year yield continues to trend higher, that means that inflation and economic growth are on the rise. So as long as we see the 10-year yield stay relatively range-bound and elevated, that's actually a good sign for the market because it indicates growth. Now, Where we are seeing a little bit of softening of data is in the US PMI. In previous videos, I talked about how this is a very important forward-looking metric to understand economic growth. And throughout the last several months, this metric has fallen sharply. That said, we are seeing a slight rebound in the US PMI, softening its rate of declines. So that implies that we're not yet nearing a recession in the next quarter. But like I said, 12 months from now, that's when we start to be a little bit more cautious. Quick pause. I heard if you smash the like button, subscribe, and turn on that bell, a recession will be pushed further out. And you never know, maybe it might never even come. With that said, let's get back to the video. Now I want to talk about why I think the equity markets have risen so quickly over the last several weeks. And that's because fixed income investors have been selling their bonds since inflation is still running very hot. And with rates rising, fixed rate investors do not want to stay locked into their fixed income instruments. And so they're selling their fixed income assets and they're buying longer duration assets such as equities. And we can see that action happening in the investment grade market where we're seeing a really large sell-off in fixed income. And like I said in previous videos, equities and fixed income are competitors for capital. And when money flows out of fixed income, they have to find a place to park. And lately it's been equities. Now I want to talk about company specific commentary from several key US consumer companies because they are major proxy outlooks for whether a recession is looming. And there's some evidence that a recession is still in the cards in the future, but as for now, we're still looking relatively stable in terms of the outlook. Let's take a look at Nike, which is a proxy for consumer consumption. They recently said that consumer demand continues to be incredibly strong. They have not been able to meet demand over the past couple of quarters. That does not sound like a recession to me. That sounds like growth is still on the table for Nike, and that's good news for the US stock market outlook. Now, let's take a look at Booking.com. And Booking.com is a major proxy for travel. And they discussed that their bookings are back to pre-COVID 2019 levels. And that's a great sign that discretionary spending continues to be relatively healthy. And I know we've seen a lot of consumer confidence data lately that indicates discretionary income weakness. But according to the latest outlooks of major consumer companies, spending continues to be relatively stable. Moving on to Disney, which is a powerful proxy for leisure and entertainment, they discussed that their park margins are essentially back to 2019 levels. And that's very impressive given all the lockdowns, all the restrictions that Disney has had to face. And that implies that once again, consumer confidence is softer than it was in the past, but it's by no means indicating a recession in the foreseeable quarters. Now, let's take a look at Walmart, a proxy for mass market consumption. And Walmart's management team discusses that the consumer continues to be healthy. There's not a lot of change in consumer behavior at this point, and that's good news because that means, once again, the outlook continues to be stable. The last company that I want to talk about is Dollar Tree, and this is a very interesting proxy for demographics with more modest means. Dollar Tree recently made a very big announcement that they're moving their $1 price point for a lot of their items to $1.25. And even after that large price hike in percentage terms, a lot of their customers from their surveys talk about how they continue to plan to shop at Dollar Tree because it's still very deep value. Now I want to move our commentary over to China and talk about Alibaba and Tencent's latest quarterly reports because it represents B2B and B2C consumption. So Tencent recently talked about how they experienced a lot of headwinds in their ads business because there continues to be weakened demand for educational services and also weakened demand for gaming services. So for that reason, Tencent reported slower than expected growth. And for Alibaba, as discussed in previous videos, they're continuing to monitor the macro health of the consumer, and they continue to view that it's most likely a U-shaped rebound rather than that V-shaped rebound. So these names have recovered significantly, as I've discussed in my previous videos, how changing monetary policy and a more dovish outlook on what policymakers are likely to do with regulation were going to impact this sector significantly. And so China has done just that. And as long as they continue to execute, we could see names in the Chinese internet sector continue to recover from here. Now, I want to offer some recession guidelines for stock selection so that when you do your own research, you're looking for companies that are tilted in your favor. You want to look at companies that have lower debt profiles, stronger operating cash flow history, and stronger liquidity on the balance sheet. And in terms of companies that are out of favor, you want to avoid highly leveraged companies with weak liquidity ratios, companies that are very cyclical or strongly dependent on the growth outlook. And you also want to avoid small caps or speculative companies with extremely high valuation. And taking a look at my secondary coverage, which is consumer discretionary, it offers a major strategy to understand any looming recession because consumer discretionary names is a powerful proxy for B2C. Let's take a look at the outlook for a lot of these companies, most of them reporting at least moderately positive guidance. That said, though, if we look at the share price technical direction, a lot of these names, excluding Amazon and Tesla, are in that price discovery mode. They're neutral. They're underperforming the rebound in technology because of that fear of a upcoming recession. Now, we are seeing counter-cyclical companies performing better than discretionary companies, and that's reflected in the fact that the market is pricing in stagflation. Dollar Tree, because they recently raised prices from $1 to $1.25 and they were able to lift their EPS significantly, the company is at an all-time high. Dollar Tree and these counter-cyclical companies are outperforming a lot of these discretionary names. So Dollar Tree is doing well. Walmart is remaining steady in a year where the NASDAQ is down close to 10% year to date. Having a company that's remaining steady is very strong outperformance. And you're seeing mega grocery store Kroger now being viewed as a safe haven. I would urge our viewers not to chase names like Kroger because even though the performance has been very strong over the last several months, its historical valuation is very expensive. So some observations I want to share include the fact that many consumer discretionary names from the ETF XLY are priced for stagflation. A lot of these valuation multiples, they're below the 5-year average. These names have 10 to 15% downside to reach their 5-year historical valuation low in the case of a formal recession. But I believe that they have a roughly 20 to 30% upside in the case of a rebound in economic growth. So these names have less volatility than tech stocks, but they also have lower total addressable markets, which could constrain their upside. So the fundamental direction of these companies is cautiously optimistic, but the technical direction of these top 10 names have not rebounded as quickly as technology. Now I want to talk about examples of where we did well and also examples of potential missed opportunities inside our inner circle. Objectiveness is a core pillar of my philosophy. We will win a lot of opportunities, but sometimes we will leave some opportunities on the table. We talked about actionable strategy on Facebook at $200 per share when it was trading at 14 times PE compared to the S&P at 18 times. We made that call in late February, and since then, Facebook has done very well. So congratulations to our members who were able to take advantage of that. And of course, the very controversial call on Alibaba. A lot of people were very skeptical. They were very fearful of sentiment, but I reminded our community that this price range of 85 to 100 continues to be a very attractive price point to add. And so once again, congratulations to our members for following through on that. We talked about mindset, staying strong when others were buckling under pressure, and also providing advice on how to be more successful in our careers so that we can hedge against market uncertainty. Now, there are some areas for reflection. After a very powerful bounce from Alibaba where it pounced 35 to 50%, I did discuss talking about margin reduction for any members who were on margin. So I talked about if you were on margin, this was the time to potentially do a little bit of rebalancing. Of course, that leaves a little bit of money on the table if the name continues to run, but I have to practice risk management. I have to practice making sure that our members can stay in the game in case there's another raft of volatility. As you can see from this summary table, there were a lot of opportunities that we were able to take advantage of, but at the same time, there were also opportunities that we did leave on the table. So our mission here is to be as objective as possible. When we win, we win. When there are opportunities we leave on the table, we stay humble and we continue to move forward from there. Now I want to take a moment to share with you a couple moments of what one of our members inside our investment community has to say. His name is Kieran from Singapore. Let's hear what he has to say.
It gives me a lot more confidence to enter the position, at the same time be more profitable at the same time. So I'm able to go for a larger position, even though I know that the market is very fearful. But at the same time, Larry also give live commentary when the market has very bad sell-off. I think in the past 2 weeks, his insights about the market do give me a lot more confidence as well. Definitely, I think you give very pinpoint guidance in terms of the entry and exit, and why are you thinking in terms of your basically your thoughts of a train of thoughts in that sense. Why do you actually choose at certain level, and why you think that the market will continue to retrace and do not need to actually panic sell or even panic to go in and things like that. So I think that part do give us a lot more conviction and be more confident in the position that we are holding right now, and enter at the same time as well.
So in summary, here's what we did in the last several weeks. We kept our members cool during the heat of the volatility while a lot of other investors sold. We helped our members to find high quality setups, and we commented in our live feeds during days of market volatility to find actionable strategy. We reminded our community of key levels to watch to ensure that risk management is done correctly, and then we provided the research that highlights clear thinking. Now, please note, I don't heavily rely on DCF or valuation models as a part of my process. It is a powerful methodology, but I invest using fundamentals, macro, and technicals, the same type of thought process that you see on my channel. So with that said, I hope you enjoyed this video to understand the looming recessions and the indicators to look forward to. Please make sure to like this video if you enjoyed the content, share it with your friends and family, and if you're new, turn on that bell, and I will see you in my next video.